Ladies and gentlemen, good day and welcome to Rishabh Instruments Q3 FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you, and over to you, ma'am.
Yeah, good morning, everyone. Welcome to the Q3 FY24 earnings call of Rishabh Instruments Limited. We have the management today being represented by Mr. Narendra Golia, Chairman and Managing Director, Mr. Dinesh Muslalekar, CEO, Mr. Vishal Kulkarni, CFO. I now hand over the floor to Mr. Golia for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Thank you, Bhumika. Welcome and good morning to all the participants in the call. Thank you for joining us on the Rishabh Instruments call, where we will discuss the Q3 results as well as the 9-month Y2D results. Along with me, as Bhumika introduced, is Dinesh Muslalekar, our Group CEO. He is with me, and there's Vishal Kulkarni, our CFO. And there are people from Strategic Growth Advisors who are our investor relations advisors. We have already uploaded the results and the press release on the stock exchanges, and I'm sure many of you had a chance to go through the same. Otherwise, I would urge you to go through it at the end of this call, because we will not discuss everything which is already put on the website. Some of you may be hearing us for the first time today. Many of you have either participated in the IPO. Many of you I have met personally. Some of you have visited here. But still, I will give a quick snapshot of our company, and then I will let Dinesh walk you through the operational performance of this quarter. And Vishal Kulkarni, our CFO, will talk about the financial performance. As Bhumika said, please reserve your questions at the end of the session, and we'll be happy to answer any clarifications that you need. As many of you have read in the DRHP, or many of you know, Rishabh Instruments is in the business of designing, developing, and manufacturing global energy efficiency solution products. So we deal with instruments which help all of people to increase the efficiency of the electricity that they use. And now, of course, energy has got different forms, So we do that. We have been doing this for the last 40 years, and our products are mainly used for energy efficiency solutions. And therefore, they are obviously influenced by energy sector developments and infrastructure spending across the globe. We can divide our products into 4 major segments. One is electrical automation. Second is metering, control, and protection devices. Third is portable test and measurement instruments. And the fourth is the miscellaneous category, including solar string inverters and some products which are under development in the pipeline. This is a new area. Solar, you all know, our Prime Minister has declared in the recent history that they will be putting solar over 1 crore households. So this is a very prospective market. We have a diverse range of about 150 product lines with more than 2 lakh SKUs, positioning ourselves as a prominent global player in the manufacturing and supply of analog panel meters and low voltage transformers. We are absolutely leading in these 2 areas. In CTs, in current transformers, we have another competitor in Germany, but still quantity-wise, we are the largest. Remarkably, 99% of our manufacturing processes are in-house. I always talk about vertical integration, and therefore we are able to maintain top-notch quality, and that's why our customers come back to us again and again. Additionally, we take pride in being pioneers as one of the first Indian companies to undertake the comprehensive design, development, and manufacturing of solar string inverters from inception to completion. Solar string inverters have come in the last 10 years, lot of being sold, but then there are a lot of imports from China. We are one Indian company who has designed, developed, manufactured, backward integrated, made the design, molds, everything. And hopefully this will become a very big revenue in the coming years. Speaking of the industry applications, we have a diversified industry base and are catering to sectors like FMCG, pharmaceuticals, cement, steel, railway, renewable, oil and gas. Wherever power is used, either generation, transmission, distribution, all these are our application areas, and we continue to grow in each and every area that we cater to. Additionally, with our die casting products from Poland, we cater to industrial automation, automobile industry, connected vehicles, which is EVs, and various other industries. We have a vertically integrated setup with 5 manufacturing units, out of which 2 are in India, 2 are in Poland, 1 is in China, backed by in-house R&D at all the 3 places with international accreditations. We also have 2 modification centers in the US and UK through our subsidiaries, where we take our products manufactured in one of these 3 locations and then do the modification for the last mile requirement which our customers may have. We have multiple certifications from ISO 50001, 9001, UL, CE, IATF, UK, CA, and many other certifications we have to be able to sell our products where we presently sell. Further, we also provide software solution development through our subsidiary in India as a forward integration to integrate instrumentation products and provide complete solutions to monitor, measure, optimize, and control energy consumption, transmission, and generation. All of you know today is the time of IoT, and therefore everything has to be connected to each other. All our instruments talk to each other, but we also give software whereby people are able to connect these instruments via our software to other devices which may be non-Rishabh or non-Lumen products. We have 2 subsidiaries in Poland, Lumel SA and Lumel Alucast. One is the electrical business, one is the aluminum business. This was one company which was acquired in 2012 from the Polish government as a single entity, but then that time they were loss-making entities. Over the years, we have turned around the company from loss-making to a healthy about 18% EBITDA margin. And we have also split the company into 2 independent companies. Both are located next to each other in a place called Chilina Góra in Poland. It's about less than 2 hours from Berlin. We take great pride in our ability as an Indian company to successfully orchestrate a turnaround in a European business landscape where many acquisitions have faltered. We have about 600 people in Poland, and maintaining this kind of workforce and making it as a profitable business was a challenge, but today it has become a routine, and now we are looking at other acquisitions also. This achievement underscores our commitment to excellence and adaptability in navigating diverse markets and operational environments. You can understand the language and everything in China to Poland to India. It's completely different culture, but we are happy to be able to manage it. Moreover, we have high market share for our products in the European market on the back of our quality and cost-effective products. Europe and Poland together account for about 60% of our geographical revenues, followed by Asia and US. So we have strategic plans to increase our market share in the US and China over the next 2 years with the launch of new products. The growth will be led by our Chinese acquisition of Shanghai VNA Instrumentation in 2019. VNA products have very robust demand in key geographical markets like Europe and US, and we will also develop the Indian market. On the industry front, a robust movement is evident in the energy sector transition. Major developed economies such as Europe and US, along with emerging economies with anticipated high future energy demand such as India, Brazil, and Indonesia, have made noteworthy strides in advancing the energy transition agendas. Our Prime Minister also keeps repeating how India will become a renewable energy source. These regions, which I just mentioned, are channeling substantial investments into infrastructure development and bolstering their energy security. While these areas are actively shifting their focus towards sustainable energy solutions, there remains a pressing need for more accelerated and inclusive transition to ensure the delivery of efficient, secure, and equitable energy solutions. The push in this market aligns with our top 3 business segments, which continue to experience a healthy and safety demand base. Further, the increased investments in the clean energy sector by European countries serve to counterbalance the effects of economic contractions in Europe and Germany for our business? Everybody has this question. But since we have so many products in the clean energy sector, we more than make up for this shrinkage of some of the markets. Simultaneously, the Indian government's announcement of heightened infrastructure spending in the upcoming year positions us to capitalize on domestic demand and explore new market opportunities. More, our aluminum die-cast business is undergoing a transformation phase. We are developing numerous critical product ranges tailored for the swiftly evolving future technology space, along with our continued commitment to innovations in the automotive sector. This strategic approach will not only enhance the product basket, but will diversify our end-user industry applications with long-term revenue visibility. Despite the challenging market scenario, we have achieved a consistent growth in revenue across product segments. Our current emphasis lies in optimizing margins with a strategic focus to increase revenues, with increasing market share across our existing product categories, together with launch of new products on a continuous basis. This reflects our commitment to adaptability and resilience in navigating complex and dynamic market landscapes. We are steadfast in our commitment to expanding our business and seizing market opportunities whenever and wherever they arise. With this, I now hand over the mic to Dinesh, our Group CEO, to take you all through the operational highlights for the last quarter and 9 months ended December 23.
Thank you, sir. Good morning, ladies and gentlemen. We have uploaded a detailed press release on the stock exchange and company's website. Hope you all had a chance to go through it. Let me start with operational highlights for the quarter and 9 months ended December 2023. Drawing your attention to our consolidated financial performance, we have achieved a turnover of rupees 1,593 million in Q3 of financial year 24, which is 19% higher year-on-year than the turnover we had in Q3 of financial year 23 of INR 1,339 million. Further, on 9 months annualized performance, we have achieved a turnover of rupees 5,118 million, which is up by 30% year-on-year performance in the respective period last year, that is on the YTD 9 months financial year 23 of rupees 3,951 million. So we are talking about top line growth of 30% year-on-year annualized basis and 19% growth quarter to quarter comparison last year to this year. That's our top line performance. Our electrical automation has grown by 19% in Q3 financial year 24 and by 29% in 9 months financial year 24 on a year-on-year basis. Metering and control devices have grown by 11% in Q3 financial year 24 and by 24% in a annualized 9 months financial year 24 on a year-on-year basis. The aluminum die casting business has grown by 16% in Q3 financial year 24 and by 26% in 9 months financial year 24 on a year-on-year basis. Portable test and measurement instruments saw a healthy double-digit growth of 53% in 9 months financial year 24 on a year-on-year basis. In other products, solar string inverter, which we just mentioned, has immense potential to add significant revenue in the next 2 to 3 years and has seen a robust growth of 460% in 9 months financial year 24. So just to summarize all of that, it is not one segment. On the top line, in every segment that we operate in, we have grown double digit. Some of those initial products which are like solar, which was at the initial phase, is started to take off. We were talking about our revenue contribution of about 1 to 2%. Now we are talking about contribution of 5 to 6%. But these will add more to the bottom line once they scale up to a certain level. Speaking on the product development side, we have added next generation inverters, Neo Radius, in 3-phase ranging from 3 kilowatt to 20 kilowatt, and continue to develop our upper range inverters up to 120 kilowatt in our R&D. So just now Mr. Golia mentioned about this whole scheme of solar houses, 1 crore solar houses. This is the product range which is tailor-made to meet those market needs in India. And our product development team in Poland has developed and introduced a lot of other high-end products such as KD6, KD10, which are paperless recorders which are used in industrial automation, N31U, universal programmable digital meters, ND31 IoT. We talk about a lot of IoT in Europe to have smart manufacturing. These are enhanced power quality analyzers. So these are the products which are more going into industrial automation segment. So the team there is focusing on what market needs. And during 9 months of FY24, we have added, around 25 new products designed and developed from not only Poland and India, but also from our R&D centers in Shanghai, also in line with our commitment to have a continuously innovate and introduce new products. And this will continue in the next financial year also. We have lined up 20 products which are in our pipeline to be added in financial year 25. The new products added in the last 2 years contributed around 10% of our incremental growth to our top line. So this is a continuous product which keeps us ahead of our competition, also helps us to beat the industry market growth by adding new products and having a market penetration. In our pursuit to enhance the customer experience, we are actively investing in our R&D facilities to innovate and design, develop manufacturing products fully in-house. Our primary objective is to enhance our product offering, leveraging our in-house capabilities to achieve distinct cost competitiveness. We hold positive outlook on exploring untapped markets to enhance our existing market share as well as penetrating into a new market to broaden our customer base. We have witnessed positive response from existing customers on the back of our quality norms and gives us confidence to tap higher market share across all the geographies that we operate. Let's now dive into entity-wise performances. Our standalone business in India has achieved revenue for quarter 3 financial year of rupees 458 million and remained flat year on year. But the revenues for 9 months on an annualized base has registered a growth of 23%. We believe we have immense potential to grow the business in India. The Indian government has announced higher spending in infrastructure development during the budget speech, and this will give more opportunities with our growing product portfolio to capture the market. Demand in India is increasing for our products, and as Indian infrastructure and economy grows, we will see its direct impact on our performance in the near future. Now, moving on to the other 2 large entities that we have, Lumel SA, which is our electronic manufacturing division in Poland. This has done extremely good. The revenues for quarter 3 financial year 24 stood at rupees 485 million and registered a growth of 37% year on year, and revenue for annualized 9 months for financial year 24 stood registered at growth of 43% on a year on year basis. So we talk about all the economic slowdown in Europe, but these are extremely good numbers both on a quarter to quarter basis as well as annualized basis, which we're talking about 43% growth in the top line. The electronics operations in Europe continues to thrive, and we don't see any challenges coming in the near future there. This is due to company's penetration into medium voltage segment and industrial automation and green energy. These are the new revenues which are adding to the top line as well as the bottom line. Further, we have invested in state-of-the-art SMT line. We have a dedicated SMT line exclusively to support EMS business in Lumel SA in Poland, which is already occupying 90% of its capacity, and we may invest more as we develop the business. In Lumel Alucas, the revenues for quarter 3 of this financial year stood at rupees 859 million with a growth of 16% year on year. Revenue for 9 months annualized basis registered a growth of 29% on a year-on-year basis. The aluminum die casting business has seen revenue increasing by 29% year-on-year. The addition of new products has impacted our EBITDA margin temporarily. We have introduced about half a dozen technically very challenging but futuristic projects in the EV space, which are going to give revenues for the next 4 to 8 years, and these are high entry barriers for others to enter. We were happy to be part of this game-changing technology which automotive industry is driving, but everybody is in the high learning curve there. So until these processes stabilize and we start leveraging the economies, so the profits will start flowing in from those new futuristic projects, which is the main concern and which has dragged our EBITDAs at the consolidated level as we saw in Q3. Overall, our European business did experience some impact, primarily attributed to slowdown in that region and transition of vehicles into EV space. However, it's noteworthy that the impact has been minimal within our industry. This resilience can be attributed to higher spending commitments by governments towards the clean energy solution, which has served as a mitigating factor against the challenges posed by the regional slowdown. So just to give some examples, the European Union has a budget of spending 12 billion to upgrade and enhance the infrastructure for the energy distribution and transmission, which is basically a need coming out of having a distributed energy sources such as solar plants, windmills, which have to be connected to the main grid. So that's something which government is expanding, and as Mr. Narendra Gole has suggested, wherever there is energy which is generated, transmitted or consumed, we are in that business. Now, a little bit brief on our China business. Our China operations have started to grow post extended COVID that we had in China. So the whole world witnessed 2 years of COVID shutdown, but we had about 3 years shutdown there. This company was acquired in 2019. 3 years we lost after that, and this is first and second year that we are reorganizing, and it has started growing now. So we have invested in our R&D and other infrastructure there. Now we registered a growth of 29% on an annualized basis this year. The strategic acquisition in China will help us to source electronic components for Lumel SA, the electronic manufacturing in Poland, and Rishabh Instruments in India, reducing the cost of raw materials. We expect about 5 to 10% reduction in our electronic component prices coming out of this strategic move which we will be doing in the coming year. V&A is also expanding R&D for new product development and expansion of current product portfolio. This acquisition will help us to serve new clients with the new product launches in China, Europe and USA territory. At present, we are at a net exporter to China. So this will change subsequently. Our other entities like Sifam, Tinsley in USA and UK entities are steadily growing. The USA business has grown by 25% and UK business has grown by 16% on 9 months annualized basis. So it's not only our product lines. Every product line has grown at the top line. Every entity also has grown at the top line. Just to make a clear emphasis on that point. Let me give you a little more insight on the margin front now. Our Q3 financial year 24 adjusted EBITDA is at rupees 137 million on a consolidated basis. It's down by 41% from Q3 of financial year 23 adjusted EBITDA of rupees 230 million. Overall, we have achieved a PAT of rupees 73 million in Q3 financial year 24, down by 59% on the year-to-year comparison for Q3 financial year 23. However, for the annualized basis, 9 months financial year 24 adjusted EBITDA stands at rupees 835 million, which is up by 42%. I repeat, 42% from 9 months annualized EBITDA of rupees 588 million. We have achieved 9 months financial year 24 year-to-date PAT of rupees 376 million in Q3 financial year 24, which is up by 9% on a year-on-year comparison from 9 months of financial year 23. The decrease in EBITDA for this quarter is mainly on account of the following three factors. ESOP cost of rupees 51 million in Q3 financial year 24 as compared to nothing in Q3 financial year 23. So this year, as we spoke in the last call also, the ESOP cost is going to be there. And then provision in relation to a withholding tax, which is of rupees INR 36 million. This we have taken as a abundant precaution. We have made a provision for that. And then operational factors. These are non-operational factors which we spoke. On the operational side, the addition of new products has impacted our EBITDA margin temporarily. However, there are long-term contracts expected to generate higher revenue going forward with better margin profits due to operational leverages to play. Our newly introduced products of solar inverters has seen multiple growth of more than 20 times in revenue for a quarter ended December 2023 on a year-on-year basis. However, the product is in its initial phase and hence the margins are lower, which are anticipated to expand once our volumes go up. The adjusted EBITDA, excluding ESOP expenses and withholding provision, has increased by 42%, as I said, on a year-on-year basis in 9 months of financial year 24, and adjusted EBITDA margin, excluding ESOP expenses and withholding provision for 9 months financial year 24 increased by 141 basis points. This was largely propelled by company's in-house cost effectiveness and process improvement initiatives, which we always do on a continuous basis. Our unwavering commitment to continue research, the introduction of new products, and catering to different industries reflects our dedication to fostering steady growth over the years. We remain steadfast in our pursuit of innovation, aiming to provide end-to-end solution to our customers. This commitment positions us to adapt to evolving market needs and ensure a sustained trajectory of growth in a long run. As we look ahead, our focus remains on innovation, sustainability, or customer satisfaction. We are strategically investing in facilities at Nashik to position ourselves as industry leaders and to capitalize on emerging opportunities. Further, it is to be noted that the overall YTD performance remains at our previous guidance, and we believe the same remains constant for the next year. We do have some seasonality impacts in Q1 and Q3, which are slightly on a steady side, but Q2 and Q4 have always performed well. This is a historical trend that we have. In the end, I would like to express my sincere appreciation to our dedicated team for their support. Now I will hand it over to Mr. Vishal Kulkarni, CFO of our group, to dwell into the financial specific details on performance of our overseas subsidiaries, after which we will be open for any questions. Thank you.
Thank you, sir, for the quick overview. Let me just give a brief on the financial performances. Good afternoon all. Starting with the company-wise key financial highlights. For Rishabh Instruments standalone business, revenue for Q3 FY24 stood at INR 458 million, and for 9 months FY24 stood at INR 1,655 million. The consolidated revenue for Q3 FY24 stood at INR 1,339 million, and for 9 months FY24 stood at INR 5,118 million. The consolidated adjusted EBITDA remained at INR 137 million in Q3 FY24 and INR 835 million in 9 months FY24. The consolidated adjusted EBITDA margins stood at 8.6% in Q3 of FY24 and 16.3% in 9 months FY24. The consolidated PAT was at INR 73 million in Q3 FY24, and it was 376 million in 9 months FY24. Now I will like to take everyone through the two big international subsidiaries that we have in the group. Lumen SA, the electronic business where we manufacture and supply products in Europe and supply to rest of the world. The revenue for Q3 and 9 months FY24 has remained at INR 485 million and INR 1,336 million respectively. The EBITDA stands at INR 101 million and INR 302 million for Q3 and 9 months FY24 respectively. Further, our aluminum die-cast business, which is under the company Lumen Alucast, has shown a steady growth in revenues both in Q3 and 9 months FY24. Our revenues in Q3 of FY24 and 9 months FY24 remain at INR 589 million and INR 1,981 million respectively. The EBITDA has remained at INR 8 million in Q3 of FY24 and INR 139 million in 9 months FY24 respectively. On the consolidated level, we remain net debt-free with a strong balance sheet. We have net cash and cash equivalents of INR 918 million as of 31st December 2023. The working capital days for 9 months FY24 stood at 118 days. The company strongly remains committed to operational efficiency and continue to see several improvements on the working capital front. With this, I shall now leave the floor open for the question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Sudhir Beda from Beda Family Office. Please proceed.
Thanks for the detailed explanation of your company's business and financial. Lot of insight we got. Sir, my question and focus would remain on the margin. So, as you explained, 3 reasons for the margin that came from 17% to 8.6%. But one of the reasons mentioned was product development. Six products that you have developed for EV. And then another product development are in pipeline. So shall we believe that margin will remain at the same level of 8.5%? Or it is one-off and then margin will come back to 17-18% of our turnover? So that.
Vedaji, thank you for your question. We would like to clarify, this is Dinesh here. I will like to clarify your answer. See, we have got basically two businesses. One is electronics business and the other one is aluminum die casting business. Electronics business, as you see, there are absolutely no problems on the margins where we develop, design and introduce new products. So, the products that we mentioned, 15 new R&D products which we developed are from the electronics business, which contribute, and we also mentioned how much of 10% of our revenues also in electronics come from the new projects that we have developed in the last 2 years. So on that side, we have another 20 new R&D products to develop and do that. That side, R&D development absolutely has no effect on the, in fact, it has a positive effect on the margins, because every time you come up with a new product you introduce, you have a higher margins, because this is your product which you are doing. Whereas when it comes to aluminum die casting business, the design of the product belongs to we are a OEM supplier. So it will belong to our tier 2 OEM who designs a very complex project, and to manufacture that there are challenges. And to stabilize those projects there is a challenge. So those products which belong to our customers, design belongs to them, and the manufacturing is also design and a technology which is complex, and there we are having the stabilization issue only on the aluminum die casting side. So as far as the continuous innovation is concerned for the product development in electronics business, which is really helped us to have a very huge margins, and that is really going to be the gain in the future also.
So what would be the expectation margin for next year we are looking at? The turnover to growing, I know that it will grow at 20-25% or more, even more than that. But what would be the expectation margin, what we are aspiring for the FY25?
Sir, we have given a guidance of 18%, EBITDA, adjusted EBITDA. When we talk about adjusted EBITDA, we are just talking about that ESOP cost and one withholding tax provision. If you take out that, 18% is what we have given a guidance, and now at an annualized base, we are at 16%, and we are sure with the last quarter, which is generally a strong quarter for us, we will be there. Around 18% will be there, and that is the guideline which we will have for the next financial year also. As in the last call also, we mentioned that some quarters will be stronger, some quarters will not be, but we always have a target on the annual results, and in that we are going in a good direction. So we don't see any risk on that.
Acceleration in the margin was one-off, yeah, in this quarter?
Absolutely, yeah.
Yeah. Thanks. And second question, we just want to understand the opportunity on the solar inverter side. Can that business be like 400-500 crore in next 3-4 years?
Yeah, absolutely, sir. We don't want to give such numbers, but what we can tell you is in a 600 crore turnover, we had 1%. Now we are talking about in an increased turnover of the group, we are talking about 5-6% turnover, contribution of that. So this we have invested a lot in design development, and we are competing against Chinese manufacturing costs. So this is really challenging, to tell you very honestly, because Chinese make them in millions. So, and supply to the whole world. So they have forced a lot of companies which were manufacturing inverters around the world to close down. But we have got our cost base competitive enough to them, and we just started to break even that and started to build the volume. Once the volumes build, then that segment also will give us more margins. We are talking about 10-15% gross margin now. So we can make higher margins in that once we have leverages. So this business, in my opinion, will cross 100 CR in about 2 to 3 years time. That's our first target, and then it will exponentially grow up. So as we are speaking, there is a big marketing campaign which we are doing in Varanasi, where until April they are going to be about 25,000 inverters which are going to be used. But we want to take a part of that share. So our team is working on that. There's a lot of schemes which are coming, and our product development also, if you see, we have 3-phase products developed from 3 kilowatt to 20 kilowatt, and single phase we are going to develop next year from 2 kilowatt to 10 or 12 kilowatt range. So just to ensure that the smaller capacity solars also can be put on the households, which our Prime Minister has announced for 1 crore houses with a solar installation. So that's we want to align our product development with what is needed in the market. So you are absolutely right. This can build into 400 to 500 crore business independently, but it will take some time, sir, because we are competing against Chinese manufacturers.
And lastly, what is the development of acquisition side?
Maybe please request you.
Just maybe if I may, last question, sir.
Haji, sir.
What is the development of acquisition side, sir? That is the last question.
Development of?
On acquisition side.
Acquisition side. Okay. Acquisition side, as we said on the aluminum die casting spare, we are looking at one potential acquisition of the size of 100 crore in India, but the due diligence are going on, so we don't want to speculate much than that, because the acquisitions until they are done, they are not done. So there is some work which is going on this side, and this also may help us to ease out our cost pressure that we have in Europe on the aluminum die casting business. If we have got a back-end manufacturing in Asia, particularly in India, this will also help us strategically in the coming years. So that's the plan, and as and when it happens, we will announce it.
Thanks for the opportunity and all the best.
Thank you very much, sir.
Thank you. Before we move to the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1. Next question is from the line of Abhishek Shah from Ambit Capital. Please proceed.
Yeah, good afternoon. Am I audible?
Yes.
So I have a couple of questions. So, firstly, on the aluminum die casting business that you are referring to, it seems, at least to me, that it seems a little unrelated to the other businesses or the other products that we offer. So, what was the logic and what's the thought process behind entering this? Was it by way of the acquisition of Lumer that we entered this business? And second question was on the EBITDA margins. You mentioned that you are developing products on the EV side which have high barriers to entry. So, any idea on what those products are and how, like, what are we looking at in terms of market size there? Thanks.
Yeah. See, the whole idea was that when we acquired Lumer, at that time, Lumer was one company. It had two businesses, aluminum and electrical. And therefore, we acquired it together. Idea was that we would probably hive off the aluminum business. But having acquired it, we got control on the business. We were able to turn it around, and we saw a huge potential in that business. And that is proven by the subsequent activities. If you see the way it has developed over the last 5-6 years, it's a profitable business, and we are sure that's why we are even now acquiring another business. So company has gone, let's say, like we went multinational, we also went multi-segment, multi-industry. And today it has become a part of the DNA of our company. So now there is no idea, at least for the next 4-5 years, of hiving off this business. So that is the answer to your first question. What was your second question, if you can repeat?
Second question, if I can answer. So we are talking about these products which are actually developed by our tier 2 customers. This we are talking about large automotive customers who have in the EV charging business, not EV charging, EV electrical vehicles, you use a lot of batteries. So for battery heat management, there are coolers and heat management products. So these are very complex products which are used in EV vehicles, electrical vehicles, to manage efficiency and increase the battery mileage for the cars. So which in Germany and in Europe, the companies are trying to push this limit. And there are new innovative products which are being done. So we are kind of a technology partners and manufacturing partners for them. So we signed the contracts for 4 to 8 years. So these are very complex and very challenging. So we are already their partners, and it's not easy for other die casting companies to enter into this segment. To that extent, we kind of secure a long-term business with these OEMs in the range of 4 to 8 years. So that there are about 5-6 those kind of projects we have signed, and we just launched them in last quarter.
Okay, understood. Thank you so much, and good luck.
Thank you, sir.
Thank you. Next question is from the line of Kush Nahar from Electrum PMS. Please proceed.
Hi, sir. Thank you for the opportunity. So my first question was, what would be a machined percentage from the die casting business in finished products?
Yeah. So in die casting, we have about 50% which is for automotive industry, and remaining is for automation industry. In automation industry, whatever we supply, that 50% which you are talking, we do a big level of forward value addition, forward integration, you can call. We do casting, we do machining, we do surface treatment, we do powder coating, we do assembling of some elements, etc. So all those products absolutely go with machining. And in the automotive side, about out of that remaining 50%, so about 35 to 40% also gets into machining. So if you look at a overall company level, what we do only as a casting is 10%. Only casting and supplying is 10%. 90% goes with casting and machining and other value add. And we are even some products we even do electronics also. Some of the products that we supply, we manufacture electronics in Lumel SA and then assemble those into these housings which have gone through all these processes which I mentioned, and give them as a more finished product. So all those margins are similar to what we generate in electronics business. The only stress we have now is on the automotive business, which is 50% of our business in aluminum die casting plant, out of which about half of them we have a new project launch. So they are having stress on the margin. So we know exactly it's one company, one product segment of one industry which is leading, and we know that it will take 6 to 9 months to fix it. So until such time, it's for us we are looking at it as an investment in future. So if you are looking on a quarter-to-quarter basis, yes, it is a loss. So we are looking at it as an investment for future. This is the perspective at least we are looking at, and we always believed, and this is how we have run the company with a mid-term to long-term perspective.
Okay, sir. And so the new products that we're launching on the EV side, so all of these would be on the finished products only machining, or that will be from casting basis only?
No. All of them are machined and assembled with the elements, with all the leak tests and other quality tests done, and they just go in the assembly line of automotive industry. So they are semi-finished complete modules which go into the assembly line.
Okay. So we can expect going ahead margins to increase on the Lumel die casting side because of the change in the mix that we'll have.
Yes.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Prateek Singh from Helios Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, just coming back on margins, even if we were to adjust for the ESOP cost of 5 odd crores and one-time provisioning of 3.5 odd crores, your core EBITDA margins, and I'm speaking ex of other income, are still tracking at around 8.5%, whereas in the previous quarters you have clocked much higher. So I just wanted to understand a bit more. Is there any margin headwind or margin pressure you are facing in any of your categories? Because even if I were to adjust for the new product, the cost related to new product launch, you would still be tracking lower than your past margin trends.
No, I haven't understood your question. You are comparing to last quarter, you are comparing to last year, you are comparing 9 months. Just clarify your questions, then I will answer it properly.
Sure. So I am comparing to your margin, whatever margins you have reported in the previous quarters also, like 1Q, 2Q, FY24, as well as your quarterly run rate across 4 quarters of FY23.
Mm-hmm.
So if I were to see, barring other income, you have always reported 10, 11 plus % margins across your quarter, be it a softer quarter, be it a stronger quarter. So this print is typically lower even after adjusting for the one-time provisions and ESOP cost also. So I just wanted to understand.
Correct. So the whole point is what Dinesh just explained. The new projects which we were launched, the aluminum business, is actually some of the projects, not everything, but some of the projects we have not yet reached stabilization. Therefore, they are not making any money, and therefore they are some of the projects also draining money. So what happens is when you try to see the overall position, you find that the aluminum business Q3 results are actually becoming a drain on the other business. So that is the reason, and that is what we said. Once they stabilize in the next 6 months, it will come back. If you see aluminum business last year, it was profit making, more or less EBITDA was same like any other business. But this third quarter, the aluminum business has not been, forget making profit. Some of the projects have made losses, and that is why you see what you are saying.
Okay. So what is the typical time before? Yeah. Sorry, sir.
No, did I answer your question or no?
Yeah. That is understood. So just to delve a bit further, sir, what are these typical scale-up costs which we incur after a launch of product? Just to understand it a bit better, if you can explain it.
Yeah. See, typically what happens when you do a estimation for a project which is going to run for 4 to 8 years. I mean, I may take a little bit of a time for you guys to understand the operational side of it. So when you are launching a project which is going to run for 4 to 8 years, so you take mostly the ideal condition, ideal cycle time. So every part has to be made in so much, and your internal rejections have to be less than, say, 10,000 ppm. So you set those parameters, and based on that, you do all the estimations. But when you run the first batch, you will generate maybe 10% scrap. So customer is not paying for that. And then you have to stabilize, you have to readjust, and then when you do that, then you do a lot of analysis, and then you sit with the engineers of the people who design this product from the customer side, and then they change the design of the product, and then you run it. So when it's a stable product which is always used, like we were making a lot of this compressor parts, we know that this is a stable product which has been there in the industry for a long period. So when you launch those products, the stabilization happens in few weeks. But when it's a new product, first time it is designed on the planet by engineers and under a lot of pressure, because there is a lot of EV pressure coming in Europe, because the European Union government has given a lot of you can call diktat to get rid of to ban all the non-EV cars, and by 2025, by 2030, there are a lot of things which are driven. So all these automotive companies under a lot of pressure to develop these products at a large scale. So EVs have been there for some companies for some time. So there is a lot of disruption which is going on to develop the products very fast. And that has put the pressure and at the design stage and manufacturing stage, and there's a disruption which is going on. So we can always decide not to be part of this game and do our steady business with the profit, and then we will not grow as much as we will grow. Then all these so we do about 50% business in automotive industry. If we don't get into this new game, then that will eventually go down. So if we want to grow, we have to take it up. And then this is what is going through a stabilization process.
Right. Understood. Just one last bit from my end. So on the provisioning, how long can this go on? Like we had some provisioning in 2Q, we have some 3.5 crores in 3Q. And any sense you can give?
We are talking about these provisions of ESOPs or? No. Okay, withholding tax, we have our tax consultants which are engaged with tax authorities, and in 1 or 2 quarters we may settle down that. So this is work in progress.
Okay. And just upon final clarification, the scale-up which typically happens, as you explained in the die casting business, usually it takes a quarter or 2 before the production line stabilizes?
Yeah, it's, normally, as I said, this is kind of little bit of unknown territory. To be safer side, we can say it may take 6 to 9 months, but generally our other products, we do it in a month's time. Not so challenging projects.
See, this is not just a new project. It's a new technology that is being developed together. The customers and the vendors, like we and our customers, we are developing it together, so it will take longer time. It's just not a new product, it's a new technology, First time introduced anywhere in the world, existed anywhere in the universe,
Mm-hmm. Right. Understood. Thanks for the detailed clarification, sir. Thank you. Appreciate it.
Okay, thanks.
Thank you. Next question is from the line of Kamlesh Kotak from Asian Market Securities. Please proceed.
Good afternoon, team. Thanks for the opportunity. Sir, I want to understand how much is the ESOP cost for the 9 months for the current year FY24 and how much it will be for the next year 25.
Okay. So the ESOP cost for this financial year is going to be 20 crores. And for the next financial year is about 111 crores, 11.4 crores. And 25-26 is 61 crores. 6 crores, sorry, 6 crores. And 26-27 is 2 crores.
Okay. And how much was 9 months, sir? 17.
9 months is 17 crores. Yeah, 17 crores approximately.
Okay. Other, sir, I just want to understand the other expenses at consolidated level, which is almost at 340 million compared to 236 million last quarter and 216 million previous year, same quarter. So I want to understand why this big jump is on what? Is it because of the Lumel or the die casting? What exactly, if you can get some more data on this?
Yeah. Vishal will give you some highlights on that. Okay.
Yeah. The other expenses, basically, there is an increase in the operations of the business. Since the revenue has been increased, the manufacturing cost is increased. And in addition to the same, there is an increase attributable to increase in the wage rates of subcontractors in Poland due to inflation. Of course, there is a tax provision in Lumel Alucast, and the power and fuel rates has also been increased in Lumel. So that has impacted the other expenses, and that is the reason the other expenses has gone up.
Okay. Okay. Thirdly, sir, about the tax rate, what is the sustainable tax rate? We have deferred credit this quarter, so what is the tax rate you expect for the year and maybe from here on for the next year?
Tax rate. For Lumel entities, there were 3 major entities. For the Lumel entities, the tax rate is around 19%, and which is about 60% of our business. For India, which is around 20% of the 30% of 25% of our business, which is at a 25% tax rate. And remaining, I will have to make a weighted average of that. So these are the things which come into our mind quickly. 22% taxes on consolidated. Yeah.
So the deferred tax which we have credit this quarter it's a one-off thing, right? It will not sustain from here on.
Yeah, the deferred tax is basically because of the tax benefit we will take from the ESOP expense, which is coming in the near future.
Okay. Lastly, sir, what is the capex we have done for this year and what is the pipeline for the next year?
From the capex which was collected from the market, we haven't spent anything from that city, so which was about 66 crores. So that is still there because we had that for the expansion of our manufacturing here. So we still have to get clearances from FY23 for expansion. So that is still untouched. And the operational, the other expenses which were to the tune of 17 crores, which are almost spent. These are so these are the two things. And other than that, general capex we have. So we did one capex in electronics business in Lumel. I mentioned that in my speech. So we introduced a fully state-of-the-art new surface mount technology SMT line to support EMS business, and we spent about €500,000 on that, which is about that's one expense which we did. And there are some capexes which are in line to expand our capacity in aluminum die casting. So we will be expanding one more production hall, which will be of the size of one football field. So we have got the plant is of the size of 4 football fields there. So this is for expanding our capacity in the die casting area. So that is going to take about 2 years. This is at a initial preliminary planning stage, which may be of the expenses may be around we talk about 4 to 5 million euros of capex there. So that is the near the plan that we have.
What we raised in the IPO in India, that was about 75 crores we raised, out of which 65 crores was for capex.
Yeah.
This we would expect to use it in the next 2 to 3 quarters. Maximum, 2 to 3 years, but majority of it will be in the coming years.
Will it be in India Nashik plant or it will be in the Lumel, sir?
It will be in India Nashik. All the capex which is raised in this in IPO will be consumed only in India Nashik.
Around 60-70 crore, is it?
Yeah.
Yes. 62 to be.
Okay. Just one more data point, if you can help me, sir. Lumel is catering to how many number of clients, if you can just highlight, particularly on the automotive side? You said new customer, new product launches. So compared to last year, how many new customers we have added, or if you can give me the count, please?
Yeah. See, the Lumel, you are talking about aluminum die casting business, right?
Yes.
Yeah. Lumel aluminum die casting side, we have non-automotive huge blue chip companies like ABB. We supply to 12 of their factories in different locations. Enrisolver, we have 4 locations we supply. Siemens, we supply to about 4 locations. So these are, I'm just taking you the big numbers. So our models of operandi is we engage with the corporate, and then we start supplying to their other factories all over. So we'll have a lot of factories added, a lot of their entities added, but at the same time, we don't want to have too many different customers, which will need to have different allies. Economies of scale will be not there. So we always try to maintain about 20 customer groups. They are not one customers. Like in automotive side, we have got Male and Valeo. Valeo, we started with one entity. Now we supply to half a dozen entities of them. Male, we started with one entity. Now we supply to all their different this thing. Just to tell you, we added Turkey, Valeo this year. Mali, we added Spain supply, all these EV projects which you're talking, we're going to supply to them. We have plants of value in Czech Republic, in Poland. So these are the big entities, and these companies which I talked about are with the revenues anywhere between 10 billion to 40 billion euros. So these are large companies with hundreds of plants all over, and we start working with them with the different entities. So
okay, great. Thank you very much, sir. That's it from my side.
Thank you. Next question is from the line of Deepak Agarwal from Param Capital. Please proceed.
Good afternoon, sir. Am I audible?
Yeah.
So my question was again on the EBITDA. So ballpark, I think if you look on a say 159 crore kind of top line, and theoretically had we done that 18% kind, would have been at 28-29 crore kind of EBITDA. Now, what we report the adjusted EBITDA is about 13.7 crores. Is it fair to say that entire gap would be related to this new product, or is it possible to quantify that, sir? Because I think that is where the entire confusion is for all investors, that if that majority of 17 crore gap relates to this new development, then adjusted for this, we are on track to do that 18% kind of.
Yeah, absolutely. You are right. And we can, we have done a lot of analysis of that by product groups by product group, companies by companies, and so it is all boiling down at I would say 90% of that is attributed to that. And also, India sales was relatively flat. So Rishabh sales in India was also flat for the quarter 3 compared to quarter 3 of the last year. So for quarter to quarter basis, we didn't have. This is a profitable business where this also has some effect. So at a macro level, if you look at, I would say 2 reasons. 80% reason is coming because of these new automotive projects which are launched in Lunel, aluminum die casting side, and 20% I would say is coming because of not growth in top line for the quarter only. But we are sure that this will be covering in quarter 4 for Rishabh. And at the end of the day, we should be okay. So that stabilization of those projects and going forward is going to be there lingering for some time. I mean, because we have got so many companies, so many product lines, I can understand the confusion that you just suggested. That's why this call is. So if we have to look at two, I would say only one point. This one is very temporary, and this the second point which I said about Rishabh is very, very temporary, which will be adjusted in the quarter 4. The only thing which will take few quarters to adjust is Lunel Alucas, those new project businesses which you are talking about.
Sure. So just a request, if possible, this quarter, I don't know, at a later date or from next quarter, if you can quantify that number, right? That really helps, because I think that entire confusion is we are 18-19% EBITDA margin company, adjusted for this one-off, which obviously will come back, right? In a way, we are taking everything to the P&L versus maybe capitalization for some of the other companies. And hence the EBITDA margin looks lower. If in the press release you could quantify that exact number, it really helps the investor that it was actually a 17-18% EBITDA number and not 8.6.
Yeah, we will try to have this EBITDA bridge kind of a thing. We'll try to have that presented.
Thanks for giving this idea, of capitalizing. I'm not saying we'll do it, but it's a good idea that this development cost, I mean, as a company, we always want to be conservative and be right of all the costs. But he just said, and I'm taking this, but we will debate internally whether it's worth capitalizing these development costs.
Right. Maybe at a very over a year, not everything through a quarter. But shorter time, maybe here is what. But it does that because for investors as outsiders, it becomes difficult that to bridge that gap on the EBITDA margin. So that was a limited point.
Good. Thanks.
Great. Yeah. Thank you so much. Thank you.
Thank you. Next question is from the line of Rahul Dhruv from Pegasus Growth. Please proceed.
Hi. Thank you for taking my call. I wanted to specifically talk about the inverter business. You mentioned that we have a gross margin of around 10 to 15% currently, and this is gross margin. What would be the operating margin in here?
The operating, it's on the solar business. So it's when we talk about gross margin, we are talking about all the it's quite similar. So when we say operating margin, it's all the direct labor and direct material, and it's at the operating level. So at the if you are looking at net level, it will be not contributing much because our G&A costs are around 14-15% of our turnover. So until this volume increases, it's not going to contribute to PAT and EBITDA. So this is just taking care of our G&A expenses at the moment.
Okay. So if we look at 100 crore turnover from inverters in say 2 or 3 years that you mentioned, where would the margins be?
The margins would be, this is, as we said, it's a very competitive margin and kind of competitive market. And this market operates at, anywhere between 15 to 20% tops. It's not going to be going more than that if you want to be in the market. So this is a kind of a business which will have better ROI, return on investment, because of the volumes. If you look at the EBITDA and gross margin, this is not. And EMS business is also similar. EMS business also, the gross margins or operating margins are low, but because of the economies of scale, your absolute numbers of profit or EBITDA will increase, but not in terms of percentages. So these are the things where the investment needed is relatively lower. And R&D, once we have done, is done. After that, it's not going to have so much of effect. So these are the typical businesses where we will be adding those to increase one, top line, second, the ROI. So they will also have a little bit of a pulling down on our overall gross margins in terms of percentage. So that's why this volume is really important. So both these businesses, EMS and this one, when they cross 100 crore, then they will start really adding more meat to the bottom line.
Basically, at around 100 crores, you'll be looking at 5-6% max margin.
Yes.
Okay. So I had another question, and this is, I'm just going through your slides, and it says that your adjusted EBITDA for the first 9 months was 83. I'm coming back to the same question because there's a lot of confusion over there. 83 crores would have been your adjusted EBITDA. The actual reported was 53. So you have a 30 crore difference. Now 30 crore difference, 17 crores is ESOP, 3 crores is, or 3.5 crores is withholding. So that leaves us with around 12.5 crores. So can I say that the 12.5 crores fully is the cost of the product development that you have taken in the P&L this year?
Not all of it, I would say. Some of the operational expenses also have gone up. So again, the same related question the other gentleman asked before. When we are stabilizing and developing these products, we are expensing out all of it. So if we have not given a thought of creating a project cost center for that and putting it in balance sheet and amortizing over a period of say 1 year or 6 months based on some logic. And if we do that, you're right, you're absolutely right. If we start doing that gap will be much lower. So it will be only to the extent of increase in wages and inflation and real operating expenses going up. So it is little bit mixed up. This is first year of we being in the market. We have been very conservative company, private limited company. We always wanted to, expense of whatever we could. That's the way we run the company. So we have to moderate. We are learning it quarter by quarter now.
Yes.
And the input which we get from you guys is really helping us. I mean, we have made a note of 2-3 very good suggestions given by you as well as other gentlemen. So we will be doing that.
Yeah. So if I have to look at just the quarter out, which is the next quarter, assuming there is, that your overall margin or the what we call the adjusted margin is at 18%, outside of the ESOP cost of around 5 odd crore or 3.5 crores left, is there anything else which can be bringing the reported number down significantly?
Okay. Could you repeat your question?
Okay. So I'm saying that let's assume we have a adjusted EBITDA or what we call as a real EBITDA of 18% margin next quarter. Okay.
Mm-hmm.
And if we have only ESOP cost, which is basically going to be or whatever, another 4-5 crores, which is going to come in the fourth quarter.
Yeah.
Will there be any major difference besides this ESOP cost in the fourth quarter between the reported number and the actual EBITDA?
No. The withholding cost and this ESOP cost are two non-operational things which we'll have. And when we are projecting 18%, this is going to come out of higher sales which we are anticipating in our electronics business, and also more stabilization of these costs which are draining out now. So they will be coming from operational side. So that's where we are projecting to have 1 or 2%, 200% basis notch up in EBITDA. So I think, yeah. Can we?
Okay. Let me ask you the other way around. Sorry about this. Will there be any further product development cost which will come in the fourth quarter?
Not really. I mean, we are talking about this expense side, any product development expenses which will be affecting our margins. Yeah, no. Whatever is there is there. So it's not going to be going up.
Okay. Thank you so much. Thank you.
Thank you, gentlemen. I think we need to end this thing. We have some meetings now. So thank you very much for your questions and hearing us very patiently.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.
Thank you.